Well, hello and welcome to this brand new episode of Smart Money. As part of our Outstanding Women in Finance series, today we have Rupal Bhansali of Ariel Investments, who's going to join me in a bit. She's the CIO and portfolio manager of Ariel's multi-billion-dollar global equity portfolios. Ariel Investment has a total AUM of over $18 billion, and Rupal has, amongst other accolades, been featured on the list of the 100 most influential women in US finance. Let me welcome Rupal on board. Rupal, please join us.
Thank you for having me.
It's great to have you here, right here in the studios with us. And, you know, it's been such a trying time, right, over the last many years. I mean, the pandemic has hit. You came out with the book as well, and here you are in India. How are you feeling?
Well, it's great to be back home. You know, for 3 years, I could not travel. So while I wrote the book a couple of years ago, I really could not get to launch it. So I'm really, really happy that people in India, which is, you know, my hometown, because I'm one of those people who went from Dalal Street to Wall Street. And in my book, I talk about all my learnings, my whole journey from this country to America. And I'm happy that I get to share it.
Oh, we are happy that you're here with us on the show. And, you know, this is a part of our Outstanding Women in Finance series, right? And we like to profile women who are perhaps trailblazers in their own way, shattering the glass ceilings. And, you know, in your book, I read that you've been born into, I guess, the equity markets. Your father had his own stockbroking business. So did it come very easy to you, getting into this business and then growing from there?
Actually, no. There were a lot of twists and turns as to what got me into finance. So since you started with my childhood, you're correct. I'm one of those few people, kids in the world, who grew up on stock stories, not fairy tales, because my dad is a stockbroker, was a stockbroker, and he would talk about stocks to his clients, and his office doubled as my bedroom, so I would overhear him talk. And of course, I didn't understand a word of what he was saying, but I was born in the 1960s. And back then, stock markets all over the world, including in India, was soaring. And so there was a lot of interest to invest in the markets. And being a broker, he did very well. So I was born, I would say, in a very well-off family. He put me in a great school. You know, we had our own apartment. We were able to, again, he was able to provide very well for his kids. But then the 70s came along and the stock market crashed. And so did our family fortunes. And I was in this, you know, Queen Mary High School, with, again, a great set of classmates, and they had a lot of things. They would do a lot of things. They would take vacations. They would buy things. And I would go home to my mom and say, you know, I want this and I want that. And she would say, sure, you know, when we have money. So I'm this 9-year-old thinking, what is this mysterious thing called money, and why don't we have it? So I was exposed to money because I didn't have it.
Okay.
And I learned at a very young age that the language of money is accounting. And I was very fortunate in my school. As part of foreign languages, they offered accounting as a language. Wow. You know, most people have French and other sorts of foreign languages. So I learned accounting when I was in school. And I think I've been speaking the language of money ever since. So that's kind of how it all started.
So you had great life lessons from the very beginning that has led you to this journey and eventually to this success, right? So tell us a little bit about, I mean, people move from Wall Street to Dalal Street to Wall Street. You've had a very interesting journey where you were brought up in India and then you went on to Wall Street. Now you live in New York, you handle the multi-billion-dollar portfolio of Ariel. How has the journey been for you?
Well, again, a lot of twists and turns because I really didn't have the money to go abroad. But I was very fortunate that the Rotary Foundation had an all-rounder scholarship. So I won it. And that's what allowed me to finance my education, you know, in the US. I wanted to go to the US because if you are going to be a money manager, you know, the sport of investing, if you're an athlete, you want to win the Olympics. And in the world of investing, if you want to be a great investor, you want to beat the S&P 500. So I knew I had to get to the US. And of course, Warren Buffett, my guru, is in that country. And so that's sort of what took me from Dalal Street to Wall Street. Okay. I would say that in terms of my journey, it's had a lot of different potholes, but every pothole I made as a stepping stone. I'm a big believer that, you know, if you just... It doesn't matter that you don't have a mentor, you don't have a certain master plan, because I didn't have either. But I just started walking in the direction of my destination, and I got there.
Okay, that's great. You know, this is, of course, a show where we provide a lot of financial literacy to our viewers. We have a lot of millennials, younger, the Gen Z, as we call it. They're, you know, tuning in and learning about the markets. Tell us a little bit about what your expectation is from 2023. Do you think this is a market where India will continue to outperform while developed markets sulk? And what could the big growth triggers be for the next year?
So Sonia, I'm a very long-term investor, I think in terms of, a multi-year period, not any particular 12-month window. But nonetheless, I do understand a lot of investors want guidance. I'm quite skeptical of this bull market rally continuing. I think it's actually a classic bear market rally. I would remind investors that when the NASDAQ fell from 2000 to 2002 by about 78%, it had 20% plus bear market rallies. So one should not get seduced by these rallies, which of course suck a lot of people into the markets again. Fact of the matter is valuations are very rich worldwide. It's not just the earnings multiple, it's the debt multiple, which few people actually care about or think about. But corporate debt worldwide has gone up a lot, including sovereign debt. And deleveraging tends to be very painful, and it causes a deflation in the multiples that people are willing to pay. So I'm actually quite bearish on global stock markets, but that includes India for 2023. That said, not everything is lost. One can position portfolios, even for a market that's going to go down. And I would say that historically, whenever we've had what I call a lost decade in stock markets, for example, in the S&P 500, we had it between 1969 to 1978 and 2000 to 2010. What a lost decade means is that the stock markets end up lower than when they started out, which means you see capital depreciation, not appreciation. Now, during those times, if you own dividend yielding stocks, they tend to help you out a lot in compounding capital. Dividends actually, in the long run history of stock markets, account for almost half the total returns. So I think people have forgotten that because there is so much money made through capital appreciation that people forget dividends play such an important role. So I think it's time to come back to the basics to look for those dividend yielding stocks.
Okay, look for dividend yielding stocks. Perhaps 2023 is going to be a year when equities doesn't perform that well. So that begs the question, right? How do you position your portfolios in such an environment? You spoke about dividend yielding stocks. Do you also look outside of equities, maybe into fixed income, debt, gold, given that there are macro concerns?
So I would say that for a very long time, people said, it's tea now. There is no alternative because interest rates were so low everywhere in the world. But I think now that has changed. Even in the US, at the short end of the curve, you will still soon be able to make 4%. And in India, I think you can make almost 8% in the fixed income markets, without taking any duration risk. So I think the short end, literally parking your money in 2-year T-bills is not a bad idea. Cash can serve as a dry powder such that when markets correct, you have cash to be able to put to work. So it cuts both ways. And these dividends that I talk about start generating cash flow for you so that you can reinvest. So I think it's sort of a twin track. Put money in fixed income, but don't take duration risk. Be at the short end of the curve.
Just trying to play the devil's advocate here from an Indian investor standpoint, right? Because despite the kitchen sink thrown at India, India has sort of come out and hit record highs. Inflation is cooling off as well. You have the macro situation that's improving. Do you think even if global equities continue to underperform and don't generate alpha, India could be a different ballgame altogether?
I wish. And I'm sorry to be the bearer of bad news here, but I would say, while I'm very bullish on India for the long term, there are lots of secular drivers and a lot of unleashed potential in the country. I think when it comes to equity markets, just like in real estate, it's about location, location, location. In equity markets, it's about earnings, earnings, and earnings. And I think that because of a global recession, I don't think India will be immune to it. And I think earnings growth will be quite challenged, and that will cause a deflating of the multiple. And when you have the combination of the two occurring, where you have a decelerating earnings growth or a decline and a multiple compressing, markets tend to go down, not up. Again, this is a very short-term view in terms of a correction. I think long-term, one of the secular drivers for not just India, but the emerging markets at large is actually this notion of inflation, which has everybody worried and caused the markets to fall. I think COVID and the move to the cloud is something that has been underestimated as a source of benefit to all emerging markets, including India. In fact, India led the way. 25 years ago, 30 years ago, we started exporting services. Before that, a lot of countries, everybody thought you export goods. And China, of course, is a big exporter of goods. And that caused inflation to come down because that was a way to create disinflation in the world. Low-cost countries produced goods at a cheaper and cheaper rate. And that helped out a lot, the global economy, but also inflation. Now, inflation has moved to the service sector. You know, it's a labor shortage, it's wage inflation, it's blue collar. So blue collar work got outsourced. Now white collar work will get outsourced. So India can be a very big beneficiary of that, just like it was in the IT industry, but now it will go beyond IT. You'll have white collar work, office work, you know, doing secretarial work, data entry, clerical work. There's just a whole bunch of work, you know, that can be outsourced because during COVID, remote working became more acceptable. And beyond that, a lot of companies have moved their processes and information to the cloud. So this is why I said the COVID and the cloud is actually a huge benefit to emerging markets, but it's a long-term story, not a short-term one.
Okay, well, let's do one thing. Let's take a quick commercial break. On the other side of the break, we do want to talk a little more about Rupal's book, the big takeaways from an investment standpoint, and of course, what it means to be a woman, a successful woman in this big bad world of finance. We'll come back in just a bit. Welcome back. You're still watching Smart Money on CNBC-TV18. I have with me Rupal Bhansali, who's the Chief Investment Officer, Global Equities at Ariel Investments. She manages an AUM of over $7 billion, and she's part of our Outstanding Women in Finance series. Rupal, apart from everything else, has also written a book called Non-Consensus Investing. So we're going to talk a little bit about that. Rupal, you know, in one of your chapters, you talk about how sizzle fizzles and patience prospers. So that's basically the importance of being a patient long-term investor. In a world full of short-termism, why is it important to be a long-term investor? And more importantly, does it still work? Because, you know, trends are changing by the hour. Forget about by the year. Does it still work to be a long-term investor?
Actually, companies that have a lasting quality and a lasting value proposition for their customers tend to be multi-baggers, compounders. And the companies that in the short run, you know, seem like they're very successful, but they don't really have strong foundations and actually are exposed to a lot of risk, they can actually fizzle out as quickly as they sizzled. I mean, just look at Facebook, Meta, which is a stock now, it is down about 75%. You know, back then, everybody talked about what can go right in that company. It had a 6 billion people customer base, right? Nothing gets better than that kind of addressable market opportunity. And it was practically a monopoly in what it did. And even so, even a successful company like that can fail. So I think there's a lot of, when people get carried away with all the things that can go right about a company, they forget to think about what can go wrong with the company. And the thing that happened with Facebook or Meta is that their business model depended upon advertising. And advertising is actually quite cyclical, and advertising is quite a commodity in that the demand for advertising, the supply of advertising determines advertising pricing. So what happened is that TikTok came along. Nobody saw TikTok coming along. And that really changed the whole supply-demand dynamics. Now, Netflix in the US is facing so much competition that they have decided to introduce advertising-based business model. So again, more supply of advertising inventory. Amazon came up with advertising inventory. So what you find is that people did not do their homework correctly. And you know, anything that looks very attractive and is successful today, people fail to ask the question, will it be successful tomorrow? So that is what I mean by sizzle, fizzle, but patience prospers. Now, a lot of people equate speed with quality. You know, express delivery, overnight delivery, high-speed internet, everything that has speed, people think that means it's great quality. But in investing, it's the opposite. Because investing is not a sprint, it's a marathon. In fact, anybody who wins the first lap is almost sure not to finish the marathon, let alone win it. You know, it's the opposite. You have to pace yourself. You don't race yourself. So I think this is why I wrote that chapter, because a lot of things about investing are very different than what you think about in life.
And I think patience and consistency are the most underrated tools to become a successful investor, right?
It's the free lunch in markets. Think about it. You can be the best trader of a seed. But if you let the seed become a flower, even if you're not a great trader, you will make way more money.
Absolutely.
And that is the power of patience. It's not the slow move, it's a smart move.
Okay. And why should people read your book? I'm asking because there are so many investment books out there. It's almost cluttered, right? The space.
Yes.
So how is your book different from others?
Well, it's a question I asked myself before I wrote the book, because I didn't want to be another one of those, investment books out there, which just repeat what has been said before. So a couple of reasons to read the book. One, a lot of books, offer platitudes. Buy high, buy low, sell high. I mean, sure, I would love to do that, but show me how to do it. A lot of people say, buy quality companies, but again, they don't tell you the how. They leave out the craft. They only tell you about the end game. So I describe the craft of doing that research. I describe how I came about my investment ideas, which ones I rejected, which ones worked out and why, which ones didn't work out. So in a sense, it's a journey of learning unless you're able to work with great investors. And I was very fortunate. I worked with Soros, I worked with some great investors. I learned from them. But not everybody gets a chance to learn at the feet of the masters. So if you can't, then there's a proxy way to learn, which is read a book like this, because it's written from a practitioner's perspective, not as a professor.
Okay.
So I think those are the kinds of things that you get from this book. Which is real life examples in the contemporary stock market world.
Okay, folks, go buy the book, read it. There are some big life lessons and investment lessons, right, in the book. What is the biggest mistake you think people make in investing?
So people think that investing is about picking the hot dot and the hot stock. It's about picking the winners. Actually, it's about avoiding the losers. If you think about it, if you start with 1,000 rupees, let's call it 100 rupees, and you lose 50%. Now you're at 50 rupees. Everybody thinks I've lost 50%, I need to make 50% to get back to my... No, if you make 50% from 50 rupees, you're only at 75 rupees. Imagine now that you only lost, first you lost 50%, so now you're having to go up 100% to get back to just where you were, right? Now, it's very hard to come up with 100% winning ideas. But let's say you have one. Let's say you have a 100% winning idea and you put that money to work, you've got back to break even. On the other hand, let's say that the idea that lost you money, instead of losing your money 50%, it only lost 20%. So now you're at 80 rupees. The same winning idea, if you put to work on 80 rupees, you have 160 rupees. Absolutely. So it's not the winning idea that makes a difference. It's the one that you lost money on that makes a difference. And a lot of people don't understand that research is not about thinking what can go right, how much the stock can go up. The first question you must ask is what can go wrong, how much can the stock go down? And you should avoid the losers first. That's the first harm of,
and that's the biggest lesson
in
Rule number
investing.
1, don't lose money.
Don't
and
lose
rule
money.
number 2, always follow rule number 1.
Correct. But people do forget it, and so I thought it was worth reiterating.
No, of course, it's a great reminder. The last chapter of your book is not on investing, but on career advice. And this show, at least this series that we're doing, is targeted towards women because it's very hard for women to survive in today's environment, especially in finance, because of, how male-dominated it is, how challenging the space is. What would your advice be to women who want to follow your footsteps?
So first and foremost, it's non-consensus career advice. So I forewarn your audience, it's not the run-of-the-mill typical stuff that you hear. And if they want to read it, actually I excerpted that chapter for free. It's on my LinkedIn post and it's also on my website, nonconsensusinvesting.com. So you can just read it. But the essential elements of the advice that I have for women is, money is a taboo topic amongst women. They don't think about it. They don't know how to invest their money. They're very daunted by it. And I'm a big believer, if you know how to cook, you can manage your money. Managing money or understanding money is not that difficult. It just, you have to get started. And just like cooking, you don't learn all cooking day one. And you learn cooking only by doing it. Yes. So I would encourage all women to earn money, because when you earn money, you learn money. Once you learn money, you will manage money. And once you manage money, I hope you will learn to multiply money. After reading this book, Non-Consensus Investing, it'll tell you at least the basics of, how to get started. But in terms of non-consensus career advice, a couple of things I would tell women. One is raise your hand, even if you feel you're not qualified for that job or that role or whatever the opportunity is ahead of you. A lot of times women feel that they need to be qualified before they will take on a responsibility. Men, on the other hand, have no such compunctions. They could completely muck up a job, but they will still take it on. And they will muck it up. But the advantage is they will learn from those mistakes. And the next time they do something similar, they will make fewer mistakes. So experience and expertise is built on the shoulders of mistakes. So my non-consensus career advice for women is make more mistakes. Put yourself out there.
Well, that is something that everyone should know, man or woman, right?
Yes.
You need to make mistakes.
Absolutely.
And that's the
Put
only way you
yourself
move
out there.
forward. So what is it? Earn money, learn money, manage money, and then multiply your money. All right. Well, on that note, thanks a lot, Rupal, for joining in. It was a pleasure speaking to you. And since this is our show where we talk about, financial literacy, every week we give our viewers one financial tip of the week. So I'm going to just take it straight to that. If you, our viewer, looking to do passive investing, then here are are some top performing index funds that we put together for you across large, mid and small caps that perhaps have given the best returns in the last 3 years. Now, these are index funds all above 100 crore AUM because that's the way you should focus. The first is the Nifty Next 50 Nippon India Nifty Next 50 Junior. You have the UTI Nifty Next 50 Index Fund. There's the DSP Nifty Next 50 Index Fund and ICICI Pru Nifty Next 50 Index Fund. So that's the list there of the top performing large cap index funds. All of these funds have in the last 3 years given you a return of anywhere between 15 to 16%. But the juice is really in the broader market. So let's move to the mid cap index funds. The two top performing funds are Motilal Oswal Nifty Mid Cap 150 Index Fund and the Nippon India ETF Nifty Mid Cap Fund. These two funds have on an average, of course, benchmarked the mid cap index and given you a return of 25% in the last 3 years. Let's move on now to the small cap index funds. One of the best performing ones has been Motilal Oswal Nifty Small Cap 250 Index Funds, which has seen a 27% return in the last 3 years. All this data has been very helpfully put together by Moneyfront, so thanks to them. And on that note, thank you for watching Smart Money. Keep writing to us and giving us all the feedback. We love hearing from you. Till we meet again, thanks a lot.